Welcome back to another pipeline trading video. Today I am going to share a complete beginner's guide to Elliott Wave Theory. The key to using the Elliott method successfully lies in counting the waves correctly and identifying the wave in which the market is currently trading in. Today I will try to help you better understand the general characteristics of the different waves within the overall market structure. One of the key points within the Elliott Wave Theory is the concept of the fractional nature of the markets. This means price patterns repeat themselves over and over again on all time frames. Under the Elliott Wave Theory, there are two types of price progressions. The first are those price movements or waves that are aligned with a larger trend. These price movements are referred to as motive waves. The second, price movements are waves that are contrary to the larger trend. These price movements are referred to as corrective waves. Motive waves can be classified further as impulse waves or diagonal waves depending on the form and location within the overall structure, and both waves are the most common form of motive waves and the easiest to spot in the market. The diagonal wave also moves the market in the direction of the trend. The difference is that the diagonal wave looks like a wedge, either expanding or contracting. Corrective waves are generally classified as either flat, zigzag, and triangle structures, or double or triple combinations. The basic form of the entire Elliott wave sequence is comprised of 5 waves that make up the motive wave, which are labeled waves 1 through 5. Following the completion of wave 5 within the motive sequence, the market will develop into a 3-wave retracement that moves contrary to this motive wave sequence. This retracement move consists of 3 waves labeled as waves A, B, and C. There are only 3 unbreakable rules as it relates to the Elliott wave principle. The first rule is that wave 2 cannot retrace more than 100% of wave 1. The second rule is that wave 4 cannot move into the territory of wave 1, and finally wave 3 cannot be the shortest wave amongst wave 1, 3, and 5. So like I said in the beginning of the video, if you learn to recognize the current wave of the market, you will be ahead of most traders. Now let me share the characteristics of the various waves within the Elliott wave structure in the context of a bull market. Pay attention to each description, and by the end of this video, Elliott wave theory will no longer appear complicated. Wave 1 begins impulse sequence. During this wave, price begins to bounce higher after a long sustained downtrend. The sentiment in the market is very bearish at the start of wave 1, as wave 1 moves higher. Most people see this upside price movement as just the bear market rally, and many traders consider wave 1 as a good opportunity to initiate a short position or add to their existing short positions. Wave 1 is generally the least predictive wave within the entire Elliott wave structure. There is really no way to know how long the wave will last. However, at some point it will become clear that the wave 1 has ended as a significant swing high is reached and prices begin to move lower in a bearish direction once again. Wave 1 generally subdivides into 5 smaller waves and can sometimes appear as a leading diagonal structure. After wave 1 completes, the next one in the sequence will be wave 2. Wave 2 will move counter to wave 1 and will retrace a large portion of wave 1. Usually wave 2 will retrace wave 1 by either a 50% retracement, a 61% retracement, or even a 78% retracement. During wave 2, investors and traders begin to feel assured once again that the downtrend has continued. However, the market will fail to break below the wave 1 low. Remember the unbreakable rules within the Elliott wave theory, which is wave 2 cannot retrace below the start of wave 1? Informed traders will begin to recognize this pattern and start a position to the long side of the market. Wave 2 will generally take the form of a zigzag direction or a flat correction. In either case, the retracement will be fairly deep. Additionally, since wave 2 is a corrective structure, it will develop as an ABC pattern comprised of 3 waves. Wave 3 offers the largest potential for profit as it's the biggest and the most powerful wave within the overall Elliott wave structure. The psychology during wave 3 is generally one of growing optimism, although many of the earlier sellers will still resist the optimistic outlook during the early stages of wave 3. It will become increasingly evident that the trend has shifted and the markets are poised to move higher. After the break of the swing high of wave 1, Prices will begin to accelerate upward as more and more traders recognize the worry sentiment and start taking long positions. Many sellers will have their stops triggered at the wave 1 swing high, which adds further fuel to the upper price momentum. If you identify the third wave, that is where you join the trend as quickly as possible in order to take advantage of the explosive moves that are in wave 3. Those that wait for a pullback to get in will often miss the entire move, as a wave 3 offers very little pullbacks, and when they are present, they tend to be shallow. Wave 3 will often travel 1.618 times the length of wave 1, measured from the end of wave 2. The second most common projection for wave 3 is for it to travel to 0.618 times the length of wave 1, measured from the end of the wave 2. One of the guidelines with interior 2 wave principle is that among waves 1, 3, and 5 of the impulse sequence, there will be one extended wave, which will be larger than the other two. In most cases, wave 3 will be that extended wave. Wave 4 will follow wave 3 and will retrace a portion of wave 3. Typically, wave 4 will be a shallower replacement and will often retrace a 38% or 50% of wave 3. Since wave 3 is often the longest wave within overall sequence, we can expect wave 4 to be less aggressive in percentage terms than wave 2. Also, you need to keep in mind one of the core rules within the Elliott theory is wave 4 should not overlap into the territory of wave 1. If it does, then you need to relabel your wave count, as this is an unbreakable rule. Wave 4 is also seen as a profit-taking wave because those traders that bought early in wave 3 are sitting on a healthy amount of profits. Many of those traders will begin to liquidate their positions and lock in profits. This creates a sideways price movement that is often prolonged to nature. Wave 4 often takes the form of a triangle. However, wave 4 can also be a flat formation, and sometimes it forms a zigzag pattern or some combination. The price action often appears range-bound, with price moving back and forth without any clear direction. Wave 4 brings price action that often creates false breakouts on either side of the market. You need to be very careful when taking your positions during wave 4, as you are more likely to lose money during this directionless market conditions. Wave 5 is the final leg within the Elliott wave and impulse sequence. It moves in the direction of the overall trend similarly to wave 1 and wave 3. During the progression of wave 5, almost everyone is bullish. Wave 5 is often considered a retail wave because during this time when most retail investors are driving prices higher, often to extreme valuations. The momentum behind this bullish activity in wave 5 will be less dynamic than during the wave 3 progression. This basically means that the velocity of the price movement will be more subdued than that seen during the wave 3. During the late stages of wave 5, we will also see technical divergence patterns that form between the price section and many momentum indicators, such as the RSI, stochastic, and the MACD. This moment on divergent signals are telling us that the strength of price movement higher is diminishing, and we should expect the upside trend to reverse soon, along with momentum divergences. Wave 5 will often register a lower volume compared to wave 3. This is another indication that the trend is weakening, and other profits should be locked in as a reversal is imminent. In terms of how far wave 5 will travel, wave 5 will terminate upon reaching a land that is equivalent to the land seen in the wave 1. The next most likely projection for wave 5 to travel is 61% the length of wave 1. Both of these projections for wave 5 are measured from the end of wave 4. The end of the wave 5 brings with it the completion of the impulse sequence. The impulse sequence consists of wave 1 through 5, and thus at the end of the wave 5 we can expect a corrective structure to follow, which will often be a 3-wave pattern. Waves A, B, and C. Wave A starts the corrective sequence. During this phase, most traders are still very bullish and consider the wave a pullback as just another minor retracement. Wave A is somewhat similar to the wave 1 infrastructure. During both of these waves, the market participants are heavily positioned on one side of the market, depending on the direction of the larger trend. However, just as in wave 1, some experienced traders begin to recognize the overbought market conditions during wave 5. Wave A is often a sharp move that may subdivide as either a 5-wave pattern or a 3-wave pattern. Wave B is the second leg of the corrective structure and follows wave A. Wave B is often considered a bull trap because it tends to draw in a lot of traders. believing that the existing trend is still healthy. However, this is far from the truth. Wave B will be a fairly short-lived pattern and will often fail to surpass the Wave 5 swing high. Wave B will often create a double top formation in which it will try to test the Wave 5 high and fail to break it. This doesn't always happen. It's quite characteristic for Wave B to fail just short of the Wave 5. Extreme Wave B is often a fairly deep replacement and will retrace Wave A by either 50%, 61%, or 78%. The subdivision within Wave B itself is often seen as a zigzag pattern, but sometimes it will form as a triangle. One of the best trades within the Elliott Wave sequence is to fade the Wave B price move as it nears its terminal point. After Wave B completes, Wave C will begin, and this wave marks the final leg within the entire corrective structure. When the wave below is taken, that will mark a turning point where more traders will become convinced that the uptrend has actually ended, and the market is poised for lower prices. Wave C has many of the same characteristics as Wave 3. Both Wave C and Wave 3 tend to be relatively long waves and can be quite powerful. Wave C is often equivalent to the length of Wave A. Wave C will travel a distance of 1.27 times the length of Wave A after this distance. The next most likely area for Wave C to terminate would be when it has traveled the distance of 1.61 times the length of Wave A, sometime going to the bottom of Wave 4. Now that you know the characteristics of each wave, let me share a simple checklist to apply to the sequence. Print it or write it down and use it every time you are unsure about the current wave of the market. Wave 1, Wave 3, and Wave 5 are trending. Wave 2 and Wave 4 are corrections of Wave 1, Wave 3, and Wave 5. Wave 3 must not be the shortest, but it doesn't have to be the longest. Wave 2 can retrace up to 99% of Wave 1. Wave 4 should not go into the price area of Wave 2. Wave 4 never enters the price territory of Wave 1. Wave 2 and Wave 4 must display alternation in as many ways as possible. That is, Wave 2 and Wave 4 must be different in as many ways as possible. Alternation occurs between Wave 2 and Wave 4 as either price, time, or pattern. In terms of price, Wave 2 when compared to Wave 4 may be obviously smaller or larger in price. In terms of time, Wave 2 when compared to Wave 4 may take much more or less time. In terms of pattern, Wave 2 may be a simple ABC. Wave 4 could be a more complex ABC, or even a triangle, or Wave 2 could be a flat formation and Wave 4 could be a zigzag, or vice versa. If you enjoy this type of content and want more Elliott Wave videos, subscribe and leave me a like to show support. Financial markets have price movements that repeat over and over again. These movements are called waves. Elliott Wave theory is a comprehensive and complex topic, taking practitioners months and even years to master. Despite its complexity, there are some elements of Elliott Wave that can be incorporated and may help improve your trade timing. So I'll try to keep this very simple, and I will break down the wave theory into small pieces. First concept: impulsive and corrective waves. Ralph Nelson Elliott, the trader who developed the Elliott Wave theory, proposed the trends in financial crisis resulted from investors' predominant psychology. He found that swings in market psychology always showed up in the same recording fractal patterns or waves. Discovered that stock index price patterns were structured in the same way. He then began to look at how these repeating patterns could be used as predictive indicators or future market moves. Now, prices move in impulsive and corrective waves. Knowing which wave is likely underway and what recent waves were will help you to forecast what the price is likely to do next. An impulsive wave is a large price move and has associated trends. An uptrend keeps reaching higher prices because the moves up are larger than the moves down, which occur between those large up waves. Corrective waves are the smaller waves that occur within a trend. So knowing this, it's a device to trade in the direction of the impulsive waves, because the price is making the largest moves in that direction. Impulsive waves provide a better chance of making a large profit than corrective waves. Do you use corrective waves to enter into a trade in an attempt to capture the next big impulsive wave? The ideal way to trade is to buy during pullbacks or corrective waves and ride the next impulsive wave as it takes the price higher. Also, you could sell during corrective waves in a downtrend to profit from the next impulsive wave down. The idea of impulsive and corrective waves is also used to determine when a trend is changing direction. If a price chart shows big moves to the upside, with small corrective waves in between, and then a much larger down move occurs, this is a signal that the uptrend may be over since impulses according to trending direction. A big move to the downside, which is bigger than the prior corrective waves and as large as the upward impulsive waves, indicates the trend is now down. If the trend is down and the big up wave occurs that is as big as the prior down waves during the downtrend, then the trend is now up and you should look to buy during the next corrective waves. Second, concept, trend, and pullback price structures. Elliott found that when an uptrend is on their way, it typically has 3 large upward price moves with 2 corrections. This creates a 5-way pattern: impulse correction and another impulse. These 5 waves are labeled wave 1 to wave 5, respectively. The uptrend is then followed by 3 waves down: 1 impulse down, a correction to the upside, and then another impulse down. These waves are labeled A, B, and C. Elliott also found that these patterns occurs on small and larger time frames. For example, the first impulse wave higher within an uptrend on the daily chart is composed of 5 waves on an hourly chart. Also, corrective waves are composed of 3 smaller waves if viewed on a smaller chart time frame. Just as impulsive and corrective waves help determine when to enter trades and in which direction the trend is moving, the price structure can do the same. Assume there was a big move to the upside, an impulsive wave, then a correction is likely to follow. That correction to the downside will often unfold in 3 ways: a drop, a small rally, and then another drop. You can use this to improve trade timing by waiting for the second drop. Getting it right. When the price starts to drop for the first time, it's too early, as another drop is likely coming. Also, once there have been 3 big moves to the upside, the uptrend may be nearing completion. An impulsive wave to the downside would then confirm that the price is likely to head lower and the uptrend is indeed over. Third concept is the correction size. So your trading plan should be to buy on corrections during an uptrend or selling on corrections in a downtrend. This is helpful to know how large the typical correction is. Based on the 5-wave pattern, wave 1 is the first impulse wave of the trend, and wave 2 is the first correction. Wave 3 is the next impulse, followed by a corrective wave 4 and impulse wave 5. Based on the research of Elliott, wave 2 is typically 60% the length of wave 1. For example, if wave 1 advances $1.10, wave 2 will likely see the price drop by about 60 cents. Wave 2 is followed by impulse wave 3. The third wave of the trend is often the largest, usually much bigger than wave 1. Wave 4 comes next, and is typically 30 to 40% the size of the wave 3. For example, if the third wave rallied $2, the price is likely to drop 60 to 80 cents during wave 4. The same concept holds true for a downtrend. These are averages seen over many trades, and trends corrections may be smaller or larger than average. On any single trade, yet even having an approximate idea of how big a correction is likely to be can help improve your trade timing significantly. There are 3 important rules in labeling waves. Rule number 1. Wave 3 can never be the shortest impulse wave. Wave 3 should be the longest of the impulse waves. But it cannot be the shortest, which means that the wave 1 or 5 cannot be longer than wave 3. Also, the height of the third wave must be higher than that of the wave 1, and if it's not higher, you have to start your recount. Remember that impulse waves are meant to be making progress, not slowing down. Therefore, if the price doesn't exceed the high of wave 2, then that means that there is no progress. Rule number 2. Wave 2 can never go beyond the start of wave 1. In other words, wave 2 shall not retrace more than 100% of wave 1. If a break occurs below his low, you need to start your recount. Rule number 3. Wave 4 can never cross in the same price area as wave 1, meaning that wave 4 can never overlap wave 1. So the low of the wave 4 cannot go below the height of wave 1. If that happens, you need a recount. Those are the 3 golden rules, but we also have 3 Elliott wave guidelines. First guideline: when the wave 3 is the longer impulsive wave, wave 5 will be almost or approximately equal to wave 1. Second guideline: The structure for wave 2 and wave 4 will alternate. If wave 2 is a sharp correction, wave 4 will be a flat correction. If wave 2 is flat, wave 4 will be sharp. The last guideline after a 5-wave impulsive advance, ABC corrections usually end in the area of prior wave for low. Elliott wave trading is not that easy to understand at first. The easiest part is the theory. The hardest part is the application part. That is why you should first utilize the concepts I have talked about in the beginning of the video. Impulsive and corrective wave trends and pullback price structures and correction size are the most important thing to remember. Only take trades in the direction of the impulsive waves and take trades during the corrective waves. Look for trade entry signals once the price has corrected the average amount. The correction isn't likely to stop exactly at the percentage levels discussed before, so taking trades slightly above or below the described percentage level is fine. Also consider keeping track of each wave in over a price structure. For example, after a 5-wave pattern to the upside, a bigger 3-wave decline usually follows. Watching the direction of the impulsive waves will signal potential trend changes and whether the signal is stronger if combined by a 5-wave impulse, pattern, or correction pattern. Understanding these Elliott wave concepts will improve your analysis skills and improve your trade timing, but it's not without its own problems. As I've said before, the theory can be complex to apply as it isn't always easy waiting for the 5-wave and the 3-wave patterns. Elliott wave is not a trading technique. There are no specific rules of entry or exit. There isn't one right way to use it in trading. As a result, the use of Elliott wave has been avoided by many traders due to the lack of understanding, but because of the apparently subjective nature of how it may be applied. Nonetheless, there are many traders who have been successfully trading using the Elliott wave theory. This video was an introduction to Elliott wave theory, and I tried not to complicate things. If you learned something in this video, subscribe and click the bell icon to stay connected. As always, this was another pipeline trading video. Stay disciplined, trade intentional, and God bless.